I'm David Barton-Grimley, Fintech Strategy Director at 11FS, and this is Fintech Insider News. This week, we're talking about the latest on the Synapse bankruptcy fallout and what it means for banking as a service in the US. We've got a roundup of the biggest AI fintech stories of the week, featuring Klarna and Bunk. And UK fans are forking out an average of £848 to see Taylor Swift's Eras Tour this summer. We discuss all of this and much more on today's show, so don't go anywhere. Hello and welcome to episode 857 of Fintech Insider. I'm David Barton-Grimley, Fintech Strategy Director here at 11FS, and I'm joined this week on Fintech Insider News by three great guests who are here to break down the biggest stories from the past week in fintech and financial services. Firstly, I'm delighted to be joined by my co-host for today, Will Jones, Chief Design and Product Officer here at 11FS. Welcome to the new show, Will. Please tell us, our listeners, a little bit about yourself and what you do at 11FS.
Yeah, sure. This is my first news show, actually. I've done many others of these, but quite excited to talk about hot topics. I do, I think it says it in the title. I look after our design and product teams and generally try to help all of the clients we work with create more lovable products that are successful and, a joy to use in a nutshell.
Awesome. We're also happy to welcome back to the show Jason Mikula, publisher, recently upgraded to Chief Sleuthing Officer at Fintech Business Weekly. Welcome back, Jason. I think the last time we spoke to you, you were in Mexico and you made us all very jealous. And I just kind of want to ask, what's it like to be a sleuth?
Yeah, that additional title started off as kind of a joke. And then one time at a conference somewhere, they actually introduced me getting onto stage saying that. And it was both amusing and somewhat embarrassing at the same time, but I'm going to own it.
I love it. Welcome back, Jason. And finally, another welcome to Aditi Subbarao, Global Financial Services Lead at Instabase. Great to have you back on Fintech Insider News. How have you been, Aditi? Can you remind our listeners about yourself and Instabase?
Absolutely. And it's great to be back, David. So I'm Aditi Subbarao. I'm the Global Financial Services Industry Lead at Instabase, which is an AI platform used by some of the largest FS&I organizations to turn their unstructured data into insights using generative AI. I am also now focusing on building out our strategic partnerships ecosystem. So if anyone listening is working on building multi-provider, end-to-end enterprise-scale solutions using AI, I'd love to hear from you. Please do reach out. Thank you for having me back.
Awesome. And with that, let's jump into the news. Now, our first story this week, and this one's from TechCrunch. Infighting among fintech players has caused TabaPay to pull out from buying bankrupt Synapse. TabaPay has abandoned its plans to purchase the assets of Synapse, a troubled banking-as-a-service startup. Synapse has filed for Chapter 11 bankruptcy, and its assets were set to be acquired by TabaPay pending bankruptcy court approval. The deal fell through due to issues with banking partner Evolve Bank and Trust, which failed to fully fund its accounts as required. They have since put in an emergency filing where Evolve says Synapse cut off access to key systems and will go to an emergency court hearing. Synapse CEO Sanket Pathak believes TabaPay can still be convinced to stay in the deal, but issues with Evolve Bank and Trust remain unsolved. Jason, so as Chief Sleuth, you've been following this one very closely and the specifics are changing all the time. What on earth is going on here?
So this is rather a complicated situation, but the current status is end users of Synapse's fintech clients do not have access to their accounts. So payment processing, ACH, wires, debit cards, any balance. And per Synapse's filings in the bankruptcy, it estimates that Synapse had about 100 fintechs with about 10 million end users. The total amount of deposits in play is not clear. It's not been disclosed as far as I'm aware, but presumably in the hundreds of millions. And all of those users are currently unable to access those funds. So that's sort of the current state of play on the fintech end user side. In regards to Synapse's bank partners, partners plural. So Evolve is the one that this has been sort of most focused on, but Evolve also worked with Lineage Bank, which handled a lot of its payment processing until May 7th give or take, as well as AMG Trust, which serves as the custodian for funds held in Synapse brokerage's cash management accounts. So there are sort of a lot of players and a lot of complexity to this. And as far as developments that happen, since you wrote this probably yesterday, the U.S. trustee, which represents the Department of Justice, sort of overseeing this bankruptcy process, moved to have it converted from a Chapter 11, which, without getting too boring on bankruptcy law, Chapter 11 is used for ongoing concern. So it basically allows a company to reorganize and remain operating into a Chapter 7 bankruptcy, which is a liquidation. And that transition is important because it means, one, currently Synapse is operating as a debtor in possession, meaning the Synapse management team executives still have some amount of control here. If it's converted to a Chapter 7, they basically have nothing to do with this process. The U.S. trustee, which is a representative of the U.S. government, handles liquidating whatever assets remain, with the purpose being to maximize return to the creditors. And the creditors are, in this case, there are two secured creditors, Triple Point Capital and Silicon Valley Bank, or SVB, a division of First Citizens. So it is quite a complex and, in no pun intended, evolving story.
Wow. I mean, it sounds like a nuclear meltdown. In fact, actually, I think that's a direct quote from a judge in the case. And I mean, you mentioned the implications for the actual end users, the end customers are quite phenomenal. There's a huge amount of them. They can't even access their phone. Where, if it does go to Chapter 7, where would you say this leaves them? Are they ever going to be able to access their accounts?
So that is a good question. And there's sort of a lot of uncertainty around that. I mean, the best example to point to is what happened when crypto firms like FTX, BlockFi, and Celsius went bankrupt, right? So FDIC insurance, and forgive me, I forget the exact comparable scheme in the UK. Is it FSCS?
Mm-hmm.
The deposit insurance scheme. That only protects depositors in the event that the bank, the insured depository institution, fails. That has not happened here. Evolve has not failed. Lineage has not failed. Synapse, which is in the scheme of licensing, it does own a broker-dealer, but Synapse, the parent company, is not any sort of specific licensed entity. So its bankruptcy, there is no specific role directly for the banking regulators. I mean, in fact, and despite the time difference, I've dialed into most of these hearings, the judge in the case directly instructed the U.S. trustee to reach out to the FDIC and Evolve's regulator, the Federal Reserve Board, but it's really not clear what role those two regulators would have, if any. So, I mean, and this is speculation, I suspect that end users will eventually get their funds back, but it may take a significant amount of time, as was the case in those crypto bankruptcies I mentioned. I mean, the core problem here is that for whatever money is being held at Evolve, Lineage, AMG, and anywhere else, the records of who that money belongs to are in Synapse's hands. And those banks, Evolve got some flack for basically freezing these programs effectively over the weekend on Saturday, May 11th. That was not, I understand why the fintech programs and end users are understandably upset. However, without access to the records that are in Synapse's control, there's really no way to continue running these programs in any sort of coherent or responsible way. So at this point, to try to resolve this mess and get the end users either access to their funds or just sort of close whatever accounts and return those funds, it is, as far as I understand, basically entirely dependent on being able to reconcile the records that Synapse holds with the amount of money sitting in these FBO accounts or these omnibus accounts at various banks. So like I said, very complicated.
Wow. And this seems to just lay threadbare the business model behind BaaS, right? and what happens when partnerships fail, or certainly when, banking as a service businesses fail. And I think as we all know, and a lot of our listeners will know, there have been a lot of failures over the last couple of years for various different reasons. But Aditi, I want to come to you maybe just to comment and think a little bit about partnerships here, because, ultimately this seems to be a collapse of trust between partners. And if we think about building fintech businesses, so much of it is based on partnerships, whether that's joint ventures or partnerships, just in terms of sharing data, of which there's all sorts of issues, of which this case actually shows. I mean, what does this say about partnerships?
And you're so right about that, David. Like, in a way, to think about it, it's almost like the level of innovation that has been happening in fintech and the kind of new products and services people are coming up with, it almost seems to be outpacing any kind of frameworks and safety structures that could and should be put around situations and structures like that. So, like, we've all read news stories around like Starbucks holding more than $1 billion on its balance sheet of people's kind of money on the Starbucks card, and same thing with Apple and so on. And the point you made earlier, Jason, it's so interesting that no protection covers any of that money. If you lose it, you lose it. So that's one way of thinking about it. But the other point around the partnerships, I think that is the really sad thing about this story, that it shines a light on how fragile these collaborations are and how fragile these partnerships can be across different providers if interests and incentives misalign, and also how quickly things can fall apart. And this is not unique to financial services. It's not unique to FS. It's like a tale as old as time, right? Like, this is what wars have been fought over for ages. But I have always believed that one of the great things about fintech is that the fintech world has an inherent propensity towards collaboration, towards community, towards kind of coming together to build outputs and outcomes. So in a way, it's almost a good reminder of saying, before we try to solve for bigger picture, like, it is so important to have the foundations robustly in place and then to have fallbacks if something goes wrong. So I think that is a very interesting perspective. And I wonder if similar kind of breakdowns are imminent in other fintech equivalents that are fast being put together as a result of all this innovation.
Thanks, Aditi. Yeah, that shows the fragility of the partnerships. And I suppose if we're saying that so much of the growth in fintech is based on partnerships, and if the regulation isn't in place to protect the parties and to regulate the industry, Jason, I want to come to you about what this says about BaaS. And I think what is confusing for me and for a lot of people about BaaS is, on the one hand, I mean, I'm just going to quote this Finastra study. So Finastra study is saying from 2022 expects the global banking as a service market to be worth $7 trillion by 2030. And all of us have listened to these trillion-dollar figures. We've been talking about it for years and years, and we've been charting the growth of this industry. And yet, on the other hand, you've got almost the kind of lived reality that I think we see when we watch the market. So this is a wonderful quote posted on X from the founder and CEO of Stilt, Rohit Mittal, who said that banking as a service started 8 to 10 years ago, and we only have one company valued at $1 billion. The whole vertical is still very small in terms of value created through exits. What would you say this story says and leaves the industry almost? It seems very fragile to me. Is it a blip, or is it something more systemic?
First, to sort of contextualize the specific stats you're referencing, I believe, so Rohit, I believe, is presumably referencing the valuation of a BaaS firm called Unit, which even that is probably no longer $1 billion, given that valuation was from a fundraise announced in early 2022, near the peak of the market, and before a lot of this sort of regulatory headwind. So, I mean, in the event that firm needed to go and raise additional capital, I'm intensely skeptical that it could do that at a valuation above or even equal to that 1 billion number. I will say I'm not familiar with exactly the metric that Finastra study is measuring. So when we say 7 trillion, well, 7 trillion of what? Like market cap of banks, market cap of BaaS companies, revenue. So it's a little bit difficult to compare these two figures. I will say that there are questions, in my mind, very legitimate questions about the sustainability of what I refer to as like the standalone BaaS middleware players. There are some quite important differences between basically the rest of the world and the US market, as so often is the case. As far as I'm aware, most companies that are described as providing banking as a service in the UK or in Europe are either themselves banks like Griffin or are licensed e-money institutions. So there is some sort of like regulatory license that they hold and use to provide those services. In the US context, and Synapse itself is actually an outlier in some ways, but Synapse, Unit, Treasury Prime, Synctera, these are not, generally speaking, entities that are themselves regulated. So then the question is, what is or what was their business model? And until fairly recently, the business model really depended on charging customer-facing fintechs program fees, collecting share of interchange, collecting what they would refer to as deposit rebates, or basically legally they can't call it a sharing interest, but functionally that's what it was. What you're seeing now is an acknowledgement that whether or not that operating model was technically legally permissible, which I believe it is legally permissible, in practice, operationally, we've seen what's happened, right? How many banks that Unit works with have gotten consent orders, or what's happening with Synapse now. And so the regulatory winds have shifted. Not that the rulebook has changed, the rulebook has not changed, but regulators are paying closer attention and enforcing the existing rules. The response we've seen has been a shift in strategy, whether or not these firms have acknowledged it, to say, oh, no, we sell software to banks. Selling software to banks, time-honored tradition. Firms like FIS, Fiserv, Jack Henry, numerous sort of cloud-based or newer cores in that space. And so what I suspect is likely to happen is that we see the revenue model shift from I'm a BaaS middleware company charging a fintech to onboard to my platform, and I'm taking some share of revenue they're generating, to a business model where these middleware companies say, I'm selling software to a bank, so a bank can run these kinds of programs. And that is what I suspect is probably a painful transition that a lot of these companies are going through right now.
Right. Thanks, Jason. It's so interesting. The whole business model is still very much under flux. Will, I want to come to you for the last word. I mean, one of the reasons why we know about all of this is because it's being played out in public. Does anyone ever come out looking good from something like this? It's just very intriguing to me that this whole sort of blow-by-blow thing is happening in the public.
I was thinking about this. I'd love to give you an example of where this has played out in public and gone really well, because I firmly believe it probably could. This example definitely hasn't, but if a firm went, actually, we could spin this. We're gonna have people tweet some things, and actually, rather than it be a story that's a little bit abstract and financial, you get a bit behind the scenes. Done right, I firmly believe you could have it go well. Can I give you an example of that? Absolutely not, which probably flies in the face of that assumption.
Well, yeah, I mean, if you spin it in the right way, then you can make it work for you, which might be what these people, I guess, are hoping will happen.
You'd have to assume that that's why they took to the internet with certain things, but
absolutely. All right. Thank you. All right. Up next, we have, and this one's from Reuters, Chime debuts advanced wage product ahead of anticipated IPO. Chime is launching a new product called MyPay that will allow customers access up to $500 of their wages before payday. Chime says MyPay has no mandatory fees or interest and does not require a credit check. It's quite remarkable. MyPay estimates a customer's wages for the cycle based on historical data and offers a person up to $500 of forecast earnings. In tandem with the launch of MyPay, Chime commissioned a national survey focusing on American payday pains, of which there are a lot. Almost 3 in 5, so that's 59% of Americans, experience pay paralysis or a wave of anxiety or fear due to low funds between pay cycles. This was especially true for millennials, with 68% feeling the effects. The average American loses 5 nights of sleep per month worrying about money, and more than 1/3 of Americans, so that's 35%, wouldn't be able to cover an unexpected $500 expense. Overall, 70% of Americans believe that they'd need to at least double their current salary to live comfortably. That's extremely bleak, Will. I want to come to you first on this because this is just such a massive impact on customer behavior. Everybody's talking about earned wage access as being this big, new, growing trend. But how viable do you think this is?
I found this fascinating. I mean, on the real positive side, it's really good to see financial services looking at the emerging jobs to be done around increasing debt and cost of living and trying to solve people's problems. But then on the negative side, realistically, this isn't going to solve anyone's debt problem. Yes, it's probably a little less predatory than a payday loan. There's, reading about the fact that there's quite a low and straightforward fee for access to this. But, like other waves of newly branded debt, like BNPL, it's another way to sort of kick the can down the road. It's another version of a last chance saloon to dodge a bad scenario. That was my initial reaction to it. Well, actually, no, my initial reaction was MyPay is not a very good name for this. It's not very creative. But once I got over that, it made me think about the way that they're describing it as well, because they're talking about this helping people go paycheck to paycheck, but also be useful for, I guess, gig economy workers as well. Now, paycheck to paycheck, I can totally see. And I can totally see how you could build an algorithm that knows when money is coming in and how much outflows and, realistically give you £500 and go, yeah, that's fine. We know they're going to get paid again. For gig workers, perhaps it's a little bit harder to predict. So there's a little bit more risk there for Chime. But also, I'm thinking about some work we did helping finfluencers in Singapore. Now, go with me on this. It feels abstract, but what we found around their jobs to be done, it wasn't necessarily, I guess, paying forwards of money an arbitrary time. Because yes, when you cannot predict your income, you do find yourself in holes of, all your outgoings. You do find yourself in holes. What people really want is income smoothing or predictability of what they're going to earn. So actually, there is a way to dress this up that probably better matches some people's scenarios, that's around making sure that you have money and be able to predict how much money you have in a world where, let's be honest, it's still a cyclical thing that happens monthly. You don't, for most people, pay your rent on a fortnightly basis. I know that's not necessarily true in the US as well, but it happens on a regular schedule. So creating products that allow you to, when your income is less predictable, fit into a world where your outgoings are a little bit more regular. I think there's more to do here. If they're calling it generally MyPay, it solves quite a narrow or like quite a vanilla use case in this example. And just like I said, it's another way to create debt, because actually, if you have an algorithm that's assessing whether how much someone should be able to loan, it should probably assess as well, if it's being good for the customer, the chance that you will ever get out of that £500 hole, or if next month you're just going to borrow it again. The other thing it needs to do, and as we think about it, what a lot of these do is basically reset where zero is for you. And a way of visualizing that through UX to show that you have borrowed from the future, like that needs to happen, because the customer needs to know where they're at. They're suddenly zero is in a different place in the month and a different point on the financial scale.
Or they just keep going further and further and further into debt, which is probably not going to benefit anybody.
Exactly that. So, to summarize what I've said, doom and gloom, more investment in some of the UX around it.
But I think what you're saying is very interesting, in that the data points that are even more interesting are not necessarily transparent. Aditi, I want to come to you on your perspective on this as well. But it's just kind of interesting that, there are people who don't have regular income who wouldn't be eligible for this.
I absolutely agree with what Will said there in terms of creating solutions and creating products for what there is a demand in the market for. And from that perspective, like if you think about it, you could almost draw parallels with like invoice financing or trade finance, where you're essentially saying, I know you have these incoming receivables in the future, I will pay you, perhaps even with a discount for them upfront, and then worry about the credit risk later. So you could almost see that as a translation of that model into the retail space. That's one way of looking at it. But from my perspective, there are two very interesting aspects to that story. Both of those Will has touched upon a little bit, but to classify them, one is the social and ethical and considerations around responsibility. And then the second aspect is the reliability and the emergence of alternative collateral for underwriting. And if I speak about the second one first, what I mean by that is traditional unsecured lending, you're going to ask for like 3 months of payslips, you're going to ask for past income history. You want that to be predictable, you want that to be regular, and then you'll use some sort of equation or formula to decide how much you will lend on the back of that. This is now taking that one step further, and exactly to Will's point, it is now opening up credit avenues for people who don't have that predictability of income. But I also foresee that with the ability and the technology to now use more data from more sources of data, and also the technology to be able to process that data and run risk models and scenarios and all kinds of analysis on that, more and more such types of underwriting will come to the fore. So why is it just income and payday? Why don't we think about the fact that you have X $100 invested in Bitcoin, or the fact that you have a painting hanging on your wall which might be worth something? Why don't I club that in with your incoming salary? And all of those things can now be used as potential collateral to underwrite on the basis of. So I think that is one very interesting thing that this product development and this idea is going to start bringing to the fore. But the second thing, which is like coming back to the social and the responsibility aspect, exactly like Will said, I think this is a band-aid. It's a short-term solution. Whereas those statistics are really disturbing statistics. And I was having a conversation at this conference the other day about financial knowledge and well-being, especially across Gen Z. I know this talks more to millennials, but even across the younger generations, they are not equipped to deal with the demands that the current cost of living crisis and the changing economy is putting on them. So I think something like this just highlights that there is more need for structural changes, better education, teaching people to manage their money better, teaching more overall budgeting skills, forecasting skills, planning skills in individuals themselves. And I know like it's not a question of saying like you don't have enough money, it's your job to figure it out, though I must confess, growing up in India, there is definitely prejudice here based on the number of Bollywood movies that start with a predatory loan shark causing a family tragedy, and then the 11-year-old kid growing up to be the protagonist who takes revenge and all of that. So I'm sure there's a little bit of that influencing my thought process. But I do think as governments, as industries, we should think of starting to tackle this problem much, much earlier in the cycle before it leads to 70% people believing their salaries are half of what they need and so on.
Yeah, you're right. It's almost like it's a depressing opportunity, isn't it? I mean, we've got this horrible economic headwinds, which is causing all of the pain that you see, and yet in there is opportunity. I mean, you know, we talk about earned wage access, but actually, in America as well, and there's a great stat from Chime's research that in 2022 Americans earned $10 trillion in wages and salaries. But 73% of workers have to wait at least 2 weeks to receive their pay. So a solution like this might not even be earned wage access. It might just be accessing the wage when you were supposed to access it in the first place. But Aditi, I think you're right in that like this is more of a foundation that could grow into something else. But Jason, I want to talk a little bit about the IPO angle here, because, you know, reading the actual article on Reuters is very, very interesting, because it does kind of feel like the vibe I'm getting is that we're going to IPO. We launched this very simple product, which we like, and that's going to help our IPO. That's gonna make a more attractive IPO. Is that what's going on here? And would this actually make a more attractive IPO?
I mean, that is a cynical but probably not incorrect analysis, right? I mean, this product announcement comes on the heels of a fairly friendly profile of the company and its co-founder CEO Chris Britt in Forbes, I think 1 or 2 weeks ago. So I mean, Chime has been very cagey about releasing much of any data on its performance, and so there's been a lot of speculation, a lot of trying to look for other ways to measure what's happening. So for instance, their processors, Galileo, can I look at what Galileo is doing and try to infer how Chime is doing? So I do think there's probably something to the idea of if they're sort of on this trajectory to IPO in 2025, they want to build that story. One of the critiques that people have made, including me, is that Chime to date has primarily had a interchange-driven business model, and analysts have somewhat soured on being so dependent on interchange as a form of revenue, particularly given the immense number of moving pieces right now in the regulatory sphere and in the payments market in the US. So you have this would not be debit interchange, but Credit Card Competition Act, which would impact Chime's credit builder product, which is a secured charge card. You have the Discover Capital One merger, which potentially could shake up how things work, given that Capital One would then own its own payment network, Discover. There's probably 1 or 2 more things I'm forgetting right now, but having so much of your business dependent on this one source of revenue is a risk. They recognize that. They want to diversify into stuff that looks more like lending. This product actually legally is structured as a line of credit. So it is quite different from a structural perspective compared to how other EWA providers legally structure their products. Something that I do think is going to be interesting to see is how many Chime users actually qualify for this, and if they qualify, what amount do they qualify for? I do want to reiterate that I agree with everything that Will and Aditi said about this isn't really a solution, right? It's better. I sadly worked in payday lending for 5 years, so I'm very familiar with that space. And if you're now paying $0 or $2 instead of paying $15 or $20 or $30 for that loan, that's obviously better for the consumer. But does it solve the core problem, which is, hey, I don't have enough money to make it 2 weeks before my next paycheck? It doesn't solve that problem. And then all too often, you get into what the advocates would call a cycle of debt, where you're using that earned wage advance every pay cycle. So all you're doing is pulling that pain forward, and then you're just perpetually doing it. So in the story of Chime, I do think it's a decent product, 0 fee or $2 for instant funding. Does it solve the fundamental problem that a Chime customer has when they use it? Not really.
Yeah.
The problem is they don't make enough money.
Yeah, absolutely. So it's a potential beachhead for revenue diversification. Interesting, but problematic. And on that note, we're just going to take a quick pause here. Back shortly. Welcome back. Before we get back into the second half of the news, a note to go check out our most recent Fintech Insider Insight show. Rachel Panjin, Ventures Product Lead at 11FS, is joined by some great guests to discuss the growth of Islamic finance in non-Muslim and Western countries. They dive into Islamic banking services in the West and the wider cultural challenges that come with that. She's joined by a panel of experts from Islamic Fintech Fund, Manzil and Wahid. Check it out in our podcast feed. It's the one just below this. Right, let's move on to our next story, and this one comes from The Guardian. Rise in ultra-long mortgages poses risk to UK retirement prospects, if that's not any more or less depressing than the last story that we talked about. Increasing number of home buyers are resorting to ultra-long mortgages extending beyond retirement age, risking their retirement prospects. Over 1 million mortgages have been arranged to extend beyond the borrower's state pension age in the last 3 years. The proportion of home loans extending into retirement increased from 31% to 42% between the final quarters of 2021 and 2023. Younger age groups, particularly 30 to 39-year-olds, are increasingly taking out mortgages lasting beyond retirement, with 39% of loans granted in the final quarter of 2023. Rising house prices and interest rates have fueled the trend. with longer mortgage terms reducing monthly repayments and enabling more people to afford homes. And I mean, Will, are we ever going to get to retire?
I very much hope so.
That would be nice.
It would be lovely. But realistically, I mean, who knows?
It's a bit depressing, isn't it? I mean, I understand the idea and the point that by extending mortgages into the future, of course, that does make housing more affordable. You know, people can move into their home, they can move out with their parents, all of that kind of stuff. But the impact on customers must be quite bleak.
Yeah, look, I think, and reading some of the stats, you have people in sort of 30 to 39, which actually were described as a younger audience, which I was really keen to hear 39-year-olds described as a younger audience, which is great. But the fact for getting on the housing ladder in the first place there, I get it. Like, if you can extend the mortgage length to reduce the payments kind of right now, that does work for some people. Some people will then go on to inherit. They might have the future earning potential that actually this isn't a long-term debt problem. But when people are taking out mortgages that are maybe 40 years in length and they're already pushing 40 themselves, does a bank give someone the tools to go, ooh, is my future earning potential mean that when I remortgage, I can keep decreasing the length of this term at a disproportionate rate because my wage is increasing? Do I have a large inheritance coming my way? Like, all of these questions should be, in terms of like caring for the consumer, a consideration just beyond current affordability and my current age. And I think that's probably the bit that's been missed here. I can imagine a great set of tools you could put in people's hands.
Yeah, you're right. It's not as simple, is it, as just saying, let's just extend the duration. There's got to be something that's a little bit more interesting. Aditi, I want to come to you on this. I mean, is there an alternative here? Is there just another way of doing this? I mean, obviously we'd all love for interest rates to come down and then things would be much more affordable, but I just don't think that's going to happen in a lot of different countries around the world. I mean, how do you think fintech could be looking at this?
Absolutely. And I think if we take a bit of a step back and compare this story and the considerations around this story with the conversation we just had around Chime, in a way, it's a very similar conversation, but we're putting a security behind that loan. So we're saying instead of future earnings, you have a real asset, you have a fixed asset that you're going to buy. So there is an inherent layer of safety in that, very similar to what Will alluded to. If you look at where house prices have gone over the last 20 to 30 years, and again, like, very aware that this is a classic case of past performance is not an indicator of future returns, but still, I almost think that in the UK, home buying and property, it is such an intrinsically emotional decision and thought process. And it's almost like a rite of passage. Like, the conversations I've had with estate agents when going through this journey myself, it's almost like, yeah, you start your first job, you get your first small flat somewhere in a happening area, then you move on to a family house somewhere in zone 2 or zone 3. Then as you grow older, you become empty nesters, you're 60, 65, you release equity. And these are standard terms that, like, every layman at a bus stop will be talking about. You release equity from the asset, you leave the deposit to your children to buy their houses, and then you go retire in the country somewhere. So I think it is so intrinsic to the fabric of UK life that there's a part of me which almost thinks it might not be as scary as that, because it's almost a given that by the time people retire, by the time they're old enough not to have like a full family living with them, they are going to downsize. They are going to sell that house. They are potentially going to have made returns on that house that is going to pay back the mortgage they have. So there is a part of it which is just a standard translation from like cash flow and income statement into balance sheet. So there's that one aspect, but obviously over 40-year horizons, you have no idea of where the market's going to go. You have no idea where interest rates are going to go and so on, which brings me to the second point that you mentioned, David. Is there a better way of doing it? And if I look at the mortgage markets across the UK and, for example, the US, there's a big difference in that the longest that you can lock in an interest rate in the UK standard horizons are 2 years, 5 years, maybe 10 years hitting at the boundaries. In the US, it's very standard practice to lock in interest rate for 30 years. Now, imagine you bought a house 5 years ago at 1.2% interest rate. You have this perpetual source of funding, which you can pay down.
That would have been amazing.
Exactly. And then you can turn around and use that money to buy crypto or Bitcoin or invest
Yes, please.
even just in the S&P. Like, you can do whatever you want with it. So it's effectively just a source of funding. And the reason they can do that is like their interest rate markets are so much more liquid, so much more long-term. The lenders can get out of their risk so much better. And I think the UK is quite unusual in that it does not have the capability of risk distribution of long-term mortgages. So another interesting point to make about these stories is none of them mention the fixed part of that mortgage. So if you have a 40-year mortgage, but you can unwind it anytime, you can remortgage anytime, you might be able to change the asset behind it anytime. If you have that flexibility, then in a way it's a great thing as a source of funding. But if it locks you into terms that you cannot change and which are not flexible, that is where the risk sort of starts changing and going up. So I think those are a few interesting aspects to think about. But I do think, again, another space where fintech can do so much. Like, it is one of the most primitive markets and industries out there. And anybody having gone through it will realize, like, if I could have a pound for every time I've thought of setting up a mortgage platform or a real estate agency myself, oh my goodness, there's definitely a lot that can be done there.
You're right. So some of the underlying facts of the products are just so inflexible. And Jason, coming to you on this, I mean, Aditi is right. This is such a UK-centric story. And in the US and a lot of other countries, it's just fundamentally different. What's your view on this?
I mean, the US is a particularly bizarre mortgage market, which is not something I really appreciated until I started traveling to the UK and Ireland with some frequency. I mean, that 30-year mortgage really can only exist through the miracle of like massive government-sponsored entities that end up soaking up the interest rate risk that results from writing a 30-year mortgage that banks do not want to hold on their balance sheet. I mean, in fact, more than 50% of mortgages that are originated in the US now are not originated by banks. They're originated by non-bank originators. So there's this entire very complex machine that makes that possible. For the consumer, it's a great product because if rates go up, my rate's locked for 30 years. I don't care that mortgages are at 7% now. I bought, whatever, and it's my mortgage is at 3%. If rates go down, no prepayment penalty, and you can refinance. So for consumers, fantastic product. Whole bunch of behind the scenes financial engineering and massive government support that makes that possible. I mean, I think the way that I would sort of analyze the story we're talking about now is very similar to Aditi. I mean, I was thinking, okay, is this a bad thing? And initially, my mind went to somewhat comparable but quite different industry, which is the lengthening of terms on used cars in this, particularly in the US, where it's like, okay, if you're poor and used cars are expensive, how can we make this more affordable? We'll just write you a 7-year loan for this used car instead of a 3 or 4-year loan. But cars are a depreciating asset. So you start to get into this problem where you have a 7-year loan, but your car dies after 4 years, you still owe the rest of the money. And okay, you go buy a new car, take a new loan, roll the old loan into it, and you just have this ever-increasing pile of debt. That is bad, right? And we've seen that with subprime auto in the US, that it puts consumers, borrowers in a bad position, and it can also be a risky asset class for lenders. In this scenario, I was trying to think through it, I mean, just on the fly here, because I did not do my homework. I was like, well, most people don't actually hold their mortgage to duration, right? As Aditi pointed out, maybe you sell the house and move, maybe you refinance or remortgage. So if you're assuming, and as we know from 2008, this is not a safe assumption, but if you're assuming how housing prices are generally going to increase, and depending on what the interest rate is, I don't necessarily have an immediate reaction that like writing a 40-year mortgage instead of a 30-year mortgage is some horrible catastrophic thing. It does inherently increase affordability by lowering that monthly payment, which should improve access to the housing market. Certainly I think there are probably some risks there if housing prices decline, if interest rates stay high or increase. But I didn't necessarily have a visceral reaction that like, oh yeah, this is going to be bad for people.
Yeah, exactly. It could be a good thing. Just being able to get the house in the first place or the flat in the first place. All right, thanks everyone. So coming up for this next section, we're going to do things a little bit differently this week. In the week where OpenAI created a huge stir with the announcement and release of GPT-40, there's also been so many AI stories in the fintech space, such as US senators debating legal safeguards for AI, as does the ECB, and SoftBank are betting their $183 billion portfolio on building an AI ecosystem. It feels like pretty much everybody is building and investing in AI. Who isn't, right? So two key stories within this we want to double click on are, and this first one comes from CNBC. So Klarna says that 90% of its employees are already using generative AI daily. And Bunk makes generative AI assistant fully conversational. That one's from Finextra. Nearly 90% of Klarna's 5,000 employees are using generative AI tools in their daily work, with departments such as communications, marketing, and legal being their biggest users. Its internal AI assistant, Kiki, is used by 85% of employees and handles around 2,000 queries daily. Meanwhile, Dutch neobank Bunk has enhanced its Gen AI assistant, Fin, to be fully conversational. Launched last year, Fin replaces the search function in the Bunk app, allowing users to ask questions about their bank accounts, spending habits, savings, and other financial matters. The upgrade enables Fin to answer sequential questions, provide faster and deeper financial insights, and offer personalized recommendations for places to visit. So I guess what these two articles are saying is that, we've gone through a bit of a hype cycle. There is now actually some adoption taking place, and businesses are actually saying, hey, we're using this and it's yielding serious value. Aditi, let me come to you first on this one as someone who is championing the use of AI at Instabase, and you have a TEDx talk on what AI is really doing to the workplace. It just absolutely makes sense to come to you first and get your thoughts on it. So what do you make of these two stories? Is this now the new normal?
My initial reaction would be, why is this news? So I would definitely consider this the new normal. And there will be a period where we see more of these stories popping up as people start taking more and more use cases into production and realize the impact they're making. And then over time, nobody will even talk about it anymore. It'll be so much an intrinsic part of day-to-day life and work that it just becomes the new normal, like you say. But there's a couple of things to highlight here. I think Klarna or even Bunk, they're not really unusual in what they're doing. A lot of companies have been doing this for a long time. Like Morgan Stanley, for example, their relationship managers, they were one of the first few people to put out a news story about their use of OpenAI, GPT, and LLMs overall. And their relationship managers were using it to give advice on investments to their private banking customers. Same thing with JP Morgan. They've already launched Index GPT, which gives investment recommendations. Same thing with the NASDAQ, who have just put out a story on Finextra about how they're using it to track market abuse and potential insider trading and so on. So I think a number of firms have started doing this already. And if I look into the numbers themselves, it says 90% of the employees are using Gen AI tools. Now, for a company like Klarna, I would actually expect that number to be bigger. Like in Instabase, every single person uses Gen AI every day, not for the actual product building company stuff, but for their own life and their own work. The interesting aspect here is it is as much being used, and I believe the Klarna news article also says that it is as much, if not more, being used by non-technical users, so business users, to write emails, for salespeople to write follow-ups and create presentations and analyze client calls, same thing for legal, same thing for HR. So that is very encouraging to see that the use cases are expanding across different industries and different verticals. And the one thing that I am actually really excited about is how this changes not just the scale of the adoption, but also the depth of usage and the value that you could get from the technology. And what I mean by that is, Fin, for example, they've highlighted that this can do sequential answering. So we now have models which can do multi-step, they can reason. So you can ask a question, and then you can ask a second question which relates back to the first question. And then you can actually have like a human-like conversation with past history and memory built into it. That's what these models can now do. And that then takes you to a space where you are not just asking one question to a chatbot, but you are capable of querying across an entire data universe. You're capable of marrying together data from an immediate question, from an instinctive customer requirement, to the tribal knowledge that you have stored across your organization, along with market data, all of that in runtime. And I think when we get to that stage, like that's where the true intelligence of AI is going to be unlocked. So all of this, definitely new normal, but there will be more news articles and there will be more new use cases that will definitely come up. It's a great space to be in.
Yeah. It sounds like we're in a good moment in time. It's been coming up to a couple of years now. The technology is rapidly maturing, as you say. And it is nice to see. I mean, you're right. Yeah, I mean, companies like Klarna and Bank being kind of on the leading edge of what you would consider technology. You would imagine that they would be using generative AI, but nonetheless, it is still kind of nice to see that there is a bit of recognition, because there is definitely doubt, particularly amongst some of the much larger multinational organizations around, how are we going to use it? Is it going to breach data policy, privacy? It's quite difficult. So it is nice to see it, and I wonder, Jason, do you think that, from your view within fintech or financial services, that we are approaching some form of tipping point where more and more businesses are opening their doors to it, and that may potentially result in, product efficiency gains, potentially even job cuts, for example?
Yeah, so I mean, I tend to agree with Aditi. It's more fun to have a little confrontation, but generally agree that this is a tool, right? And my current operating hypothesis is, generative AI is not going to fundamentally change what financial services looks like, what the products are, what the business models are, but that doesn't mean there aren't opportunities to leverage them for very real efficiencies, right? And I think, in addition to the Klarna story you're citing today, I believe they had a similar sort of news story a couple weeks or months back about essentially like replacing some number of hundreds of customer service staffers with Gen AI tools. Similarly, a firm, which is also in the BNPL space, earlier this week or last week, had a news item about Gen Z preferring to use Gen AI based chatbots, right? So that's not changing what is the product, but it is changing in aspect of the customer service around that product. So I mean, like I said, my best guess at how this sort of plays out over time is, saying something is AI powered, I always have to laugh at, because it's like, 3 years ago it was saying something was blockchain powered, and 5 years before that it was like, oh, it's big data powered. There's always sort of like the marketing and PR and appealing to the press, appealing to VCs, investors, and then there's the reality. I think the reality is these are tools that can be used across an organization the same way that Excel or Google Slides can be used across the organization. And you're seeing that experimentation happen now live in real time, and where they generate value and where they're useful, people will use them organically, bottom up and top down. I don't necessarily think all of a sudden a year from now, there's going to be some crazy different mortgage product or some weird credit card as a result of AI. I could be wrong, so mark it. We'll come back to it in a year, but I really don't think that's going to be what the impact in banking or in financial services is. I think you're going to see some of this like user experience layer. I actually am a Bunk customer, and I just tested it now, and it hallucinated and claimed that I spent money at Lidl, which I did not. But yeah, it's experimentation, and where it adds value either as an internal tool or as a customer-facing experience, layer, it'll stick around. Where it doesn't add value, it won't.
That's a very interesting point on your experience with Bunk and the hallucinations, because I find one of the biggest obstacles or sources of resistance is the reliability of AI and the work that AI is doing. And my personal recommendation here is always that, would you trust this job to a single human being to do by themselves? And then would you say that, okay, if you're not feeling well and maybe you have a headache or maybe you're tired and haven't slept for the last 3 days and you can still take a decision on this, then perhaps you might be able to get away with just using AI. But if not, if you have a maker-checker process with human beings, you absolutely need a maker-checker process with AI. You absolutely need to have some sort of human intervention in that you cannot trust it to take high-stakes, high-risk decisions by itself until potentially like the modules get so much smarter, or we have AGI or whatever. But as things stand at the moment, exactly like you said, Jason, it is a tool. It's like Excel. It's a device which you use. It's much smarter. It's much faster. It can sometimes impress you with how cool it is, but you still need a human being who calls the shots ultimately, which then brings us to the point of the jobs. And the sad thing here is that the jobs that are being lost and the jobs that are being created are unfortunately not fungible, though both are equally true. There are jobs being lost, like the same article which talks about Klarna's usage of AI also talks about how the outsourcing firm that they are contracting with lost more than 20% of its market cap because of this news. And there are people who are losing the jobs, but those are the processes and functions that can be automated with AI, whereas the people who are creating new jobs and the opportunities that are coming up are the skill sets that AI, at least as of now, cannot replace. So I think this also then brings up the question of reskilling. What should the workforce be thinking of? What should fintech be saying that here are the new jobs that are being created? This is how we effectively take everybody in the ecosystem, like up the ladder of value creation from the mundane and repetitive automatable stuff to the value-added human interaction, common sense, logic. Logic is the wrong word, but like higher human interaction related things. So I think that's definitely an interesting pause for thought in the whole AI trajectory.
And both of you are beginning to touch on whether or not a customer would trust AI to do something for them, because a lot of the discussion we've been having so far is AI as a tool. Right, it's AI as software, as Excel, I think, as you said, Jason. Will, I'd like to come to you for your kind of last view on customers and how would they ever trust this?
Yeah, and look, all of you have touched on it so far, and I think it's interesting. Like, we can sit here and go, "Why is this news?" And that is because we're in the position of being on a tech podcast where it's slightly newsworthy, but it's not revolutionary. I genuinely think in the public consciousness, something like Fin from that we were talking about, that does feel quite newsworthy. It feels quite different, and that I guess brings us on to the trust point. Like we always talk about, like the waves of better financial services being a move away from, I guess, commodity products that are quite fixed and, for want of a better word, stupid, to intelligent services. Yep. If you take PFM, for example, which is effectively Fin is the ultimate like outcome from that. Like the commodity being, I'm showing someone just a balance. What the customer actually wants being, will I make it to the end of the month? Do I have enough money to buy, X, Y, Z? Actually being able to interrogate that and get answers back is the first port of call for trust. Now, I think Jason made a good point that if it's telling you shopped at Lidl and you did not, you're immediately going, "Oh Christ, my details have been stolen again," and it's a big alert. So accuracy, 100% has to be there. But how many of us have looked at, what's relatively quite dumb PFM and gone, "You've categorized that wrong." We still sort of stick with it to give us a nudge as to how we're doing and what we're spending. I do think if you take that mindset to correct, direct, and answer a question, you could walk into a bank like you would regularly do in a not too distant past and go, "Oh, can you tell me blah, 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 blah." They might get that wrong. And you just go, "I think you've got that wrong." The Fin example here is quite good because you can just follow up and go, "I don't think that's correct." So being able to chain things and being able to have inherently a memory to it and not just being a call and answer means it is a tool that you can feel like you can input into and correct. So I think that is a step towards trust, and probably we're a way away, I think Aditi was saying, from making very important decisions. The mortgage example is a great one because quite a lot of people get so much more from a real mortgage broker that you can lay all of your life out in front of and go, "Please help me," than they would do some of the like robo brokers that are there that are quite good at giving you standard scenarios. I know that's a slight abstraction, but again, you need to be able to have an intelligent conversation to just cover all stops for those big decisions. And that's why we like to have several people involved and be able to interrogate it. So this does genuinely, while being not necessarily newsworthy, feel like in public consciousness, things like this do take us on that road toward trust, I think.
Yeah, it's fascinating. I'm definitely not going to be trusting a chatbot at any point in the future with buying me a house. Please buy me a house. Okay, well, that would be nice.
No, you could buy a Tesla for $1. So I mean, it depends on where you start.
That would be great. I'd love to buy a Tesla for $1.
Did you hear that news story of how somebody convinced a chatbot to sell them a Tesla for $1?
No, that's wonderful.
I love that.
I love that.
Yeah. So I think, there's definitely arbitrage opportunities in there.
So there is room to grow. There is still time for these products to maybe get a little bit better than they are at the moment. All right. Fascinating discussion. I'm sure we could talk about this to the end of the world. But now it's time for the "and finally" section of the show, which is a look at something a little bit different from the world of finance. And this one is from the BBC. Taylor Swift's Eras Tour will be worth $1 billion to the UK economy, says Barclays. According to research from Barclays, more than 1 million fans will pay an average of £848 each. Wow. To see Taylor Swift live this summer. The UK leg of the Eras Tour kicks off in Edinburgh next month, taking in shows in Liverpool, Cardiff and London, including 8 nights at Wembley Stadium. The Eras Tour has already broken numerous records. Upon its completion next year, it's expected to become the biggest tour in history, grossing over $1 billion. As well as the tickets themselves, UK fans will be forking out on travel, accommodation, merch, food, new outfits, or even travelling to see Taylor live across Europe if they couldn't get tickets closer to home. I mean, I just want to be totally transparent. I am not spending £848 to see Taylor Swift, although I do know a lot of people who are and doing it. So who here in the panel is looking forward to the tour? Is anyone going?
I did check if there were tickets, but the resale tickets were like over €1,000, and I just can't do it.
Has anyone traveled like a really long distance to see a band or go to a gig?
Sheffield?
Is that far for you, Will?
No, it's not. I was living in Leeds at the time. I thought it was make it sound. I mean, this is another example. All of my Taylor Swift news comes to me involuntarily. I don't look for it, and here we are again on another format. I'm not a hater, so I super talented, and the business that she's. I mean, 'cause she is a business now.
Yes.
I think half of the products about borrowing money is. While it's great for the UK economy, how are people paying for these tickets?
Well,
that's my question.
I mean, it's a lot of money for this target demographic, right? So are they going into debt or doing something very interesting? Anyone traveled far to see a band?
I think the furthest I've been is to Hyde Park. So I'm definitely not the right demographic for this. But also,
none of us are musical.
Like, I must confess, like, in my head, Swift still leads me to like the Swift, like our payment Swift, as opposed to Taylor Swift. And I'm sure there's such a huge PR opportunity there, right? Like she becomes the face of Swift or something like
Wow.
that. But
This is
I hope
definitely-
somebody at Swift is taking note.
Yeah, this is definitely a fintech podcast, isn't it?
I
the only
want to
thing
see
I
the
would-
crossover between Swift and Taylor Swift as some sort of like promotional campaign for international remittance.
Yeah,
Exactly.
definitely.
Exactly.
I would highly encourage you all actually to watch it, as I have. I have actually watched it. I think it's on Disney. I could be wrong, but it is
The
absolutely.
movie.
Yeah, and it's a recording of it. It is absolutely extraordinary. I think what this news article is really saying is the size of this show is unlike anything I think that anyone has ever seen before. And one of the reasons why I watched it is because my son is absolutely obsessed with Taylor Swift and obsessed with guitars. So he has like a little guitar and he plays along to it. So that's why I've watched it. My wife also loves Taylor Swift, but it is an economy in of itself. The whole thing is massive. Well, that's great. Lots of you are very musical. Lots of traveling to see gigs and lots of lively conversation. On that wonderful note, thank you everyone. That wraps up this week's Fintech Insider News. Thank you so much to today's guests. Where can people find out a little bit more about you? Jason, start us off.
They can subscribe to the newsletter at fintechbusinessweekly.com, find out whatever the latest with the Synapse bankruptcy is. And they can also find me on Twitter at Mikula JA or on LinkedIn.
And Aditi.
So some of the stuff that I've spoken about on AI, please go to instabase.com and try out AI Hub. You can literally build your own solutions using GPT and LLMs. And please do reach out to me on LinkedIn and email.
Awesome. Thank you. And Will?
Don't find me on Twitter. I forgot my login years ago, but you can find me on LinkedIn and obviously 11FS through future episodes of this and at 11fs.com.
It's also technically X now. I wonder when it's just going to be X and everyone forgets Twitter. Will we all just doggedly keep calling it Twitter?
Probably.
Because that's what I will do. And as for me, you can find me on LinkedIn at DavidBG. Thanks for listening. If you like what you've heard, please follow our podcast and don't forget to leave us a review. It helps to make a better show and helps others find us. As always, if you want to join the conversation, find us on social media. Just search for 11FS or Fintech Insider or email podcasts at 11fs.com. Thanks very much, everyone, and goodbye.